Risk assets enjoyed another strong week. Investors had been reassured on the previous Friday that Donald Trump's comments on China had not been overly aggressive. Elsewhere, mobility indicators showed activity was slowly recovering from pandemic conditions. There was good news on the economic data front as advanced PMI figures generally turned out better than expected. China's improvement was particularly marked as data came in above 50, a sign that the country really was returning to growth. Caixin PMI actually hit 55, its highest level since 2010. Europe also enjoyed positive surprises, although in absolute terms, the Eurozone's composite PMI remained at a feeble 31.9. To cap it all, U.S. jobless data was less bad than expected. ADP said only 2.76 million jobs were lost, or much lower than the 9 million expected. The ECB meeting fulfilled all its promises. Chair Christine Lagarde said the Pandemic Emergency Purchase Program would be raised by 600 billion euros, or much more than expected, and that the program would now run out in June 2021 at the earliest. Germany adopted an extra aid package of 130 billion euros, and Donald Trump suggested that there might be another plan for the U.S. Lagging assets led gains over the week, particularly in the Eurozone, where the risk of a new political crisis abated after the Franco-German initiative received European Commission backing. Financials were the best performers. In this risk-on environment, government bonds rose, especially in the U.S., where they had been treading water for several weeks. We remain relatively cautious, but have, however, reduced duration in portfolios. We continue to prefer corporate bonds as they have central bank support. On the equity front, we tactically reinforced discounted European stocks a few weeks ago while reducing exposure to the U.S. Equity markets moved to 3-month highs as successful lockdown exits fueled hopes for a sharp recovery. Continued government and central bank support also upstaged U.S.-China tensions and riots in the U.S. cities. ECB measures have overall been more substantial than expected. In the latest development, the bank increased its asset purchasing program by 600 billion euros and extended it to the end of June 2021 at least. Berlin managed to reach a compromise for 130 million euro aid package that includes a VAT cut for the rest of the year, bigger than expected subsidies for electric vehicle purchases, and investments in 5G and railway networks. The initial rebound on equity markets was underpinned by defensive and visible growth stocks, but leadership has now passed to more cyclical areas like oil companies and autos. Healthcare, which is among the best performing sectors year to date, lagged the trend. Some stocks were also lifted by the Chinese economic recovery. Rémy Cointreau now sees a strong recovery and in the second half and has raised its guidance. Adidas also said trading in China had improved in May. Property sector stocks like Unibail and Hammerson also rose as shopping centers reopened for business. Unibail said it had finalized the sale of 5 shopping centers for 2 billion euros. AXA surprised the market by only announcing a cut to its dividend for fiscal year 2019, defying strong regulatory pressure from the group to pass completely on its payout. Once again, U.S. indices ended the period decisively in positive territory, with the Dow Jones up 3.47%, the S&P 500 2.73% better, and the Nasdaq 2.63% higher. Investors continued to rotate into value-like financials and industrials, while high-growth stocks lagged. Services in China, the U.S., and Europe recovered more quickly than manufacturing. PMI data confirmed impressions in the field. In developed economies, the hardest hit sectors are now showing signs of recovery. Retail sales started rising, hotel occupancy rates increased, and restaurants began to take more bookings. Demonstrations across the U.S. led to a historic curfew in Manhattan, and many stores had to close. According to ADP data, the private sector shed 2.76 million jobs in May, or much less than the 9.25 million penciled in by analysts. Retail, transport, and utilities saw the biggest drops. The leisure and hospitality sector plunged 46%, the biggest percentage drop year over year. U.S. employment report shows an unemployment rate of 13.3% in May, while it was expected to be over 19%. Oil prices rallied on upbeat indications from the OPEC-Russia talks. Saudi Arabia and Russia had reportedly agreed to extend production cuts, but other cartel members like Iraq were said to be less keen. There was a chance OPEC could meet over the weekend to decide on the issue. In stock news, American Airlines soared 41%, helped by a government rescue plan and an increase in activity. The airline flew 110,000 passengers in May, or 71% more than in April. Zoom Video released unprecedented results, announcing 300 million daily users. Its market cap rose to flirt with the $60 billion level. The rebound continued with the Topix and Nikkei 225, up by 2.57% and 3.74% respectively. Everyday life started to recover after the state of emergency was lifted nationwide. Markets were buoyed by positive sentiment and massive liquidity created by global fiscal measures and monetary easing, even if there were some new COVID-19 cases in the Tokyo area in the latter part of the week. Outperforming sectors included economy-sensitive sectors such as machinery, on signs of recovery in China, glass and ceramics, metal products, electric equipment, and transportation equipment. On the other hand, pharmaceuticals reversed previous gains, and defensives like fishery and agriculture and electric power and gas retreated as investors turned more bullish. The MSCI EM index was up by an impressive 6.3% as at Tuesday's close in a broad-based rally across regions. Brazil's Bovespa and India's S&P BSE Sensex jumped 7.4% and 5.4%, and the FTSE Greater China Index ended 5.6% higher. On the economic front, China Caixin Services PMI rose to 55 in May from 44.4 in April, hitting its highest level since late 2010. Composite PMI rose to 54.5 from 47.6, its strongest reading since January 2011. Hainan said it was lifting duty-free purchase quotas to 100,000 renminbi per person per year by 2025 versus 30,000 currently. Singapore and China have agreed to create a fast lane to facilitate essential businesses and official travel between both countries. It will link 6 Chinese provinces and municipalities, as well as Singapore. The scheme is open to residents in Singapore and China who need to make essential business or official trips between the two countries, and will be gradually expanded to other Chinese provinces and municipalities. Following the U.S. order to stop Chinese airlines from flying to the U.S., the Civil Aviation Administration of China said it was easing initial international flight restrictions. If no positive COVID-19 cases for passengers are recorded for 3 consecutive weeks, an additional flight frequency per week will be granted for the airline in question. To address U.S. moves to curb Chinese ADR listings in the U.S., NetEase proceeded with a $2.6 billion secondary listing in Hong Kong, and Pinduoduo e-commerce had reportedly asked China International Capital Corporation to sponsor its Hong Kong listing. Well, that's all for today. Thank you for watching. Subscribe to our channel to track the market pulse and get the latest economic data. Good luck trading.